Part 2 of how to slash CGT on your investment property. Second strategy is main resident exemption and the 6 years rule. So the second strategy to avoid CGT is by using the main resident exemption. Usually, when you sell your main home, you don't have to pay CGT. However, if the property was once your home, but then become an investment property, like when you rent it out, you may still be able to get the exemption. Under the 6 years rule, you can still claim full main resident exemption after renting your home out for up to 6 years. So if you decide to rent the property and then sell it within 6 years, you may avoid CGT altogether. This is a powerful strategy for those who have moved out of their main home but don't want to be penalized with CGT when they sell it later. However, be cautious. The ATO has warned people who love home improvement shows a bit too much and become a serial flippers. If you repeatedly buy, renovate, and then sell properties for a profit, the ATO may treat you as running a property empire, not an passive investor. So in this case, your property sales will be on revenue accounts, which means you will be taxed 100% on the gain, no 50% CGT discount, no main resident exemption, and you can also be liable for GST. If you start repeating this strategy, please just bring an accountant before you make any sales. Remember, before you make any sales. And the third strategy is using capital losses to offset capital gains. If you've incurred a loss on other assets, such as shares or bonds, you can use those losses to reduce your capital gains. One effective strategy is tax loss harvesting, where you sell underperforming shares to realize a capital loss, which then can offset against the capital gains from your investment property. This can be particularly useful near the end of the financial year, allowing you to actively manage your tax position. If you still believe in long-term growth of the shares, you can repurchase them at a favorable market price. This approach allows you to lower your CGT while maintaining the same investment portfolio. While tax loss harvesting is a legitimate strategy, it's important to ensure transactions are commercially driven and not solely for tax benefit. The ATO may consider these transactions as a wash sale and deny the losses. You can find more information on the ATO's view in TR 2008/1, which talks about tax avoidance or artificial loss creation. The next strategy is